You watch your portfolio climb past $1 million. Years of discipline finally paying off. Then 12 months later, almost $180,000 has vanished. Not because the market crashed, not because you picked bad stocks, not because a recession wiped everyone out. It disappeared because of one habit that looked too small to matter. Every morning, it slipped through your fingers without making a sound. You never saw it as an investment decision. That was the mistake. The habit lived in your wallet. The damage showed up inside your portfolio. You are 26 years old with $12,000 invested. Your salary is decent. You save every month. Friends call you responsible because you never miss a bill, and you rarely carry debt. You think investing is the hard part, so you spend hours comparing exchange-traded funds, reading company reports, and listening to market experts. Then every payday something strange happens. You reward yourself. Nothing dramatic, just a nicer dinner. A premium subscription you barely use. Faster delivery because waiting feels inconvenient. Small upgrades everywhere. None of them seem expensive alone. Each purchase feels earned because you worked hard. Your portfolio still grows, so you don't question the pattern. The hidden mechanic isn't the spending itself. It's the way unpredictable lifestyle spending quietly steals the exact dollars that would have bought assets during ordinary market days. Most people think investing success comes from finding better returns. In reality, many fortunes are built because someone consistently had cash available when everyone else simply had receipts. You don't notice the difference during a good month. Then one afternoon, the market suddenly falls 10%. Financial news turns negative. Social media screams panic. Everyone talks about bargains. You feel excited because you've been waiting for this moment. Then you open your bank account. There's almost nothing left after the month's casual spending. You can't buy when prices are finally attractive because your opportunity fund disappeared, one harmless purchase at a time. The market recovers over the next few months without you. You don't lose money on paper. You lose ownership. That difference follows you far longer than one bad decision. Most people think missing one buying opportunity isn't important. The next level proves why they're wrong. You are 32 years old now. Your portfolio has reached $90,000. Your income doubled over the last few years. Promotions came. Bonuses arrived. You finally feel like investing is becoming serious. But your lifestyle quietly evolved even faster. The apartment became larger. The car payment became heavier. Vacations became expected instead of special. Every raise disappeared before your investments ever saw it. You still tell yourself you're investing consistently because the monthly contribution hasn't stopped. The number just never changed. Here's the mechanic almost nobody explains. Lifestyle inflation doesn't only reduce your savings rate. It freezes your investment engine at yesterday's size, while your earning power keeps growing. Your income compounds upward. Your investments don't. The gap between what you could invest and what you actually invest becomes larger every single year. That's invisible because your portfolio keeps rising anyway. You mistake progress for optimization. One Friday, your employer announces performance bonuses. Your coworkers celebrate. You immediately imagine the home theater you've wanted. The bonus arrives. Within 3 weeks, it's gone. Not wasted. Just absorbed into a better version of everyday life. Months later, you review your investment account and realize something uncomfortable. That same bonus could have purchased shares producing dividends for decades. Those dividends could have purchased more shares automatically. Those shares could have produced even more dividends. Instead, the bonus became furniture that already feels ordinary. You didn't spend money. You traded future ownership for temporary comfort without realizing the exchange happened. That realization hurts more than any market decline, because the market never forced the decision. You did. The frightening part isn't the amount you spent. It's how easily your brain justified every purchase individually, while completely hiding their combined effect. Million-dollar portfolios are rarely destroyed by one reckless gamble. They're quietly weakened by thousands of reasonable decisions that never look dangerous alone. And the next level reveals the habit that makes even disciplined investors unknowingly repeat this mistake for decades. You are 38 years old, with $320,000 invested. From the outside, everything looks impressive. Your income is higher than ever. Your portfolio statements arrive with numbers that would have amazed your younger self. Friends ask you for investing advice because they assume you've figured out the game. But a different habit has quietly taken control. Every unexpected expense comes straight out of your investments. The car needs repairs. You sell a few shares. The roof leaks. You sell a few more. A family emergency appears. More shares disappear. Each sale feels logical, because that's what investments are for, right? Not always. Here's the hidden mechanic. Every share you sell today isn't just worth today's price. It's every future year of growth, every future dividend, and every future compounding cycle that share would have experienced if it had simply remained untouched. Most investors calculate what they gained by investing. Almost nobody calculates what they permanently erased by interrupting compounding. The damage compounds in reverse. Imagine you sell $20,000 worth of investments to cover a series of expenses over 2 years. If those investments would have doubled over the next decade, you didn't really spend $20,000. You spent $40,000 of future wealth. If they tripled, the real cost becomes even larger. One afternoon, you're reviewing old account statements. You notice a stock you sold years ago. At the time, selling felt responsible. Today, those same shares would be worth more than enough to cover every expense that forced you to sell them. The realization lands like a punch. The emergency wasn't the real problem. The absence of a separate financial buffer was. Your personal finance decision determined your investing outcome, not the market, not interest rates, not inflation, just one missing layer between your daily life and your long-term assets. You promise yourself it won't happen again. But the next habit is even quieter, because it doesn't involve spending at all. You are 45 years old with $680,000 invested. Retirement finally feels visible instead of theoretical. You contribute consistently. You avoid panic selling. You don't chase meme stocks. You believe discipline is now your greatest strength. Then discipline quietly becomes complacency. Your cash begins piling up, not because you're preparing for a specific purchase, because investing starts feeling uncomfortable whenever prices reach new highs. You wait for the perfect entry. Markets continue climbing. You wait longer. Months become years. The hidden mechanic is called cash drag, but the phrase sounds harmless. The reality isn't. Every dollar sitting idle while waiting for perfect timing misses every dividend, every recovery, every unexpected rally that history repeatedly delivers before investors feel emotionally ready. You tell yourself you're being patient. The market interprets it differently. The market simply moves on without you. One evening, you calculate how much cash has been sitting in your accounts over the last 4 years. The number shocks you. That idle money alone could have pushed your portfolio comfortably beyond $1 million if it had simply entered the market gradually, instead of waiting for certainty that never arrived. You weren't protecting your wealth. You were protecting your emotions. There's a huge difference. The market doesn't reward confidence. It rewards participation. Perfection quietly became the most expensive financial habit you ever developed. And just when you think you've finally identified the biggest mistake, another habit appears that costs even more because it feels responsible, earns praise from everyone around you, and slowly convinces intelligent investors to sacrifice extraordinary wealth for the comforting illusion of financial control. You are 53 years old with $860,000 invested. You have worked for decades. You have avoided major financial disasters. You have never gambled your future away. People describe you as careful, organized, and financially responsible. They're right. That's exactly why this habit becomes so dangerous. You begin paying every extra dollar toward eliminating every possible expense before investing another cent. The mortgage, the car, small debts that carry manageable interest. Every spare dollar is redirected toward creating the feeling of complete financial safety. Safety feels incredible. Progress slows without feeling like it has. Here's the hidden mechanic. Not every guaranteed dollar saved creates more wealth than an invested dollar compounding for years. Sometimes the opportunity cost of delaying ownership becomes larger than the certainty of removing a low-cost obligation. The math changes with interest rates, taxes, and expected returns, but your emotions rarely notice the difference. They only notice relief. One weekend you open 2 spreadsheets. The first shows how proud you felt becoming completely debt-free. The second shows what those delayed investment contributions would likely be worth today if they had compounded uninterrupted. For the first time, you realize that peace of mind carried a price tag. Not because paying debt is always wrong, because treating every debt exactly the same kept you from asking the better question. What creates the greatest long-term ownership? That single question could have changed everything. Right there. Before you move on, I want to ask you something. Have you ever made a financial decision that felt completely responsible, only to realize years later it quietly cost you far more than you expected? Tell me the exact moment in the comments, because someone reading your answer today might avoid repeating the same mistake. And as you think about that moment, your own story isn't finished yet, because you still believe the finish line is $1 million. It isn't. The final habit doesn't stop you from reaching $1 million. It quietly prevents that million from becoming the lasting freedom you imagined. And that's where the biggest difference between ordinary investors and truly wealthy people finally reveals itself. You are 60 years old. Your portfolio finally crosses $1 million. The number you've chased for decades is sitting on the screen. You smile. Then something unexpected happens. Nothing changes. The anxiety doesn't disappear. The fear of making a mistake is still there. The urge to check the market every morning is still there. The habit that quietly damaged your portfolio was never just about money. It was about believing that wealth is built inside an investment account. It isn't. Wealth is built long before the money ever reaches the market. Every investment decision begins as a personal finance decision. The coffee you didn't think about. The bonus you immediately spent. The emergency fund you never built. The cash you kept waiting for the perfect moment. The financial choices you made because they felt emotionally safe instead of mathematically powerful. Those moments never appeared on your brokerage statement. Yet every one of them shaped it. That's the hidden relationship almost everyone misses. People spend years searching for the perfect stock, the perfect fund, the perfect strategy. Meanwhile, the real leak happens before the investment is even made. Markets don't know whether you skipped a luxury purchase. They don't know whether you built an emergency reserve. They don't know whether you resisted lifestyle inflation after your promotion, but they reward every dollar that arrives, every single time. Compounding is completely indifferent. It doesn't care why the money came. It only cares that it stayed. Think back to the beginning. You watched $180,000 quietly disappear. You assumed the market was responsible. Now you know something very different. The market only revealed what your daily habits had already decided. The portfolio wasn't destroyed in one dramatic moment. It was weakened thousands of times before anyone noticed. Every small financial choice cast a vote for one of two futures. One future owned more assets every year. The other owned more temporary comforts. Neither decision felt important in the moment. Together, they became a lifetime. That's why million-dollar portfolios are rarely created by extraordinary intelligence. They're usually created by ordinary decisions, repeated with extraordinary consistency. And they're rarely damaged by spectacular mistakes. They're quietly eroded by habits that never look dangerous until decades have passed. So here's the real question. If someone secretly followed every financial habit you practiced over the last 12 months, without seeing your income or your investment account, would they eventually build the kind of portfolio you want? Or would they inherit the same invisible leaks? Answer that honestly in the comments. Not for me, for yourself. Because that answer says more about your financial future than your current net worth ever will. If this changed the way you think about the connection between everyday money habits and long-term investing, subscribe and stay with us. Every week we uncover another hidden relationship that quietly separates people who merely earn money from people who quietly build lasting wealth. And if today's lesson made you realize your biggest risk isn't the market but your own financial behavior, watch our episode on the invisible cash flow mistakes that keep high-income earners from becoming truly wealthy. If you've already mastered your spending habits, but want to understand what happens after your money enters the market, the next video on compounding traps and overlooked portfolio killers is the perfect place to continue. Because the biggest financial breakthroughs almost never come from discovering something new. They come from finally seeing what was quietly there all along. You remember the moment it all began. You looked at a portfolio that had fallen by $180,000, and your first instinct was to blame the market. Now you've come full circle. The market wasn't the first domino. The habit was. That loss didn't begin with a bad investment. It began with hundreds of ordinary financial decisions that quietly redirected money away from ownership and toward consumption, comfort, or delay. By the time the portfolio reflected the damage, the real decisions had already been made months and even years earlier. That's the part nobody celebrates because it isn't exciting. There are no breaking news headlines about building an emergency fund, no viral posts about resisting lifestyle inflation, no dramatic market charts showing the value of investing every bonus instead of upgrading your lifestyle. Yet those quiet decisions are exactly what separate a comfortable retirement from lasting financial freedom. Imagine looking back 20 years from now. You won't remember the exact day the market gained 2%. You probably won't remember which stock was the best performer in a particular year. But you'll remember the habits that shaped your life, the choices that gave you options, the discipline that let compounding do its job without interruption. So here's my challenge for you. Don't tell me what stock you're buying next. Tell me which daily money habit you're changing first. Will you finally build that emergency fund? Will you stop waiting for the perfect time to invest? Will you increase your investment every time your income grows? Or will you finally identify the one invisible leak that's been quietly draining your future? Write your answer in the comments using just one sentence. I'd genuinely like to see which habit people believe has the biggest long-term impact. And your answer might help someone else recognize a mistake before it costs them years of compounding. If you enjoy uncovering the hidden connections between everyday financial behavior and long-term wealth, subscribe and join us. Every episode builds on the last, because real wealth isn't created by isolated tricks. It's created by understanding how small decisions shape massive outcomes over time. And if today's story sounded familiar, don't stop here. Watch our episode on the hidden cash flow mistakes that quietly keep high earners from becoming wealthy. Then watch our breakdown of the compounding traps that silently reduce investment returns even when you're doing almost everything right. Because the biggest threat to your portfolio usually isn't the next market crash. It's the habit you still think doesn't matter. Before you leave, do one quick test. If this video made you realize you've been making one small money habit that could quietly cost you hundreds of thousands over your lifetime, hit the like button. Think of it as making your first profitable financial decision today. Now I want to hear something specific in the comments. Finish this sentence. The habit I'm stopping today is... Don't write a paragraph, just that one habit. It could be impulse spending, waiting for the perfect time to invest, lifestyle inflation, or something completely different. Reading what everyone writes might help someone else spot a financial leak they've never noticed. And if you know someone who's great at picking investments but terrible at managing their everyday money, send them this video. They may discover that their biggest investing mistake has nothing to do with the stock market at all. Subscribe if you're interested in the hidden connections between everyday financial decisions and long-term wealth. Because on this channel, we don't just talk about making more money. We uncover the invisible habits that decide whether you keep it, grow it, or quietly lose it.